as we have been discussing the next turning point and the definition of the new Age CFO, let me begin by asking one common question to all the CFOs present here. I will start with you, Arnab ji. First of all, sir, which is your favorite car?
Sorry.
Which is your favorite car? Are you excited about the GST 2.0?
I think extremely positive about the GST. And look, I'll give you some stat, probably some happy stat to start with. So if you see India's GDP, 17% of India's GDP is manufacturing. And out of the manufacturing GDP, 49% of the manufacturing GDP is auto. The auto was growing in the last couple of years at 1 to 2%. The industry consensus is it is going to come back to 6 to 8. So you can do a math of the impact of GST 2.0 in the economy.
CFO ने बोलना शुरू कर दिया. Okay, so to begin with, let me ask one common question to all of you, and I will start with you, Mr. Roy. Is what is your next turning point? What is the turning point that you see? Because I mean, there are many challenges, sometimes precedented, unprecedented. Currently, a lot of uncertainty is happening in and around. We do not know how the geopolitical tensions will shape up. We do not know in what mode and what form the tariffs will be implemented on us after 50%, and how the second quarter will look like, right? So amidst this, what is the next turning point that all of you see? I will start with you and then move to everyone.
I'll break it into two parts, the long term and the short term. First, I will focus on long term so that we are not distracted with the short term, what is happening. In the long term, I see two things happening. One is fundamentally on the market side of it or in the customer side of it. See, technology, as we have been discussing and you will discuss throughout the day, is impacting us on all fronts. But on the consumer front, and especially with Gen Zs coming into the customer, the personalization of goods is going to be a big trend. Because if you see us versus our children, the personalization is much more needed. And that will drive a lot of change in the consumer behavior. So this I see is a big turn happening, including companies like us which manufactures car. We are thinking of how to keep the car, say, at a semi-finished stage, for a lack of better word, and then personalize it with the advent of tech into the needs of the customer. So this is going to be the next big trend, in my opinion. Consequence of that, and with the multiplicity and complexity of tech in manufacturing, and I'm limiting myself to manufacturing here, the whole manufacturing footprint is going to get to a transformation. The reason being, if you see 5 years back from today, most of the assets today are now connected assets. The assets communicate both ways. The impact of that into the whole infrastructure, impact of us to get deeper into efficiencies, is going to be much more transformed. And as CFOs, one of the suggestions which I would for all of you is, look, if you are a manufacturing company, depending on your product, between 70 to 75% of your cost is cost of goods sold. So please rethink how you are reopening the whole chapter, how you are going deeper in taking advantage of the tech in manufacturing and challenging each and every aspects of your manufacturing. That's going to be the next big trend. So that's on the long term. The third thing which Amol touched upon in his beginning, which I think both in short and long term will play, is the whole regulatory part of it. See, one of the things which is happening at a government with the connected tech, most of the government departments now are talking to each other. We have already heard of GST and income tax talking to each other. The next big transformation is coming on customs talking to income tax. So take a step back, wear your CA hats, and then imagine what does it mean. The revenue objective of transfer pricing and customs is exactly diametrically opposite. So when you are taking a decision on pricing on an intercompany, you have to see it from both dimensions. I won't blabber about it because that's a session in itself. But this is going to be a next big trend on tech. Short term, of course, Trump tariff and other things will continue. I'm not going to go into that, but these are the long-term things.
Meaningful one, Mr. Roy. Thanks for sharing that. Mr. Sircar, good to see you. In fact, one interesting thing is, before you answer the question on turning point, I have been meeting Mr. Sircar since I think 7 years now. And I can tell you very nicely, proudly that he looks the same. I don't think even a change of 1 gram here and there. Is it because of the renewable energy or something? Yes.
So on that happy note, in the context of the turning point, I think we have to see ourselves in the context of the economy and the geopolitics in the midst of which we are. So where exactly are we? With all the noise that we hear on tariff and all that. Now our economy is growing at about 6% or so, and significant contribution from private consumption, significant contribution from private investments, complemented by government expenditure. And this is a nice structure, it's a sustainable structure. Now, what is the issue, especially in the context of the geopolitics, is that we want to be self sufficient and we want to be competitive. Now, when we say we want to be self sufficient, one of the things that comes in the way is the dependence on imports that we have across our sectors, mainly manufacturing, obviously. Uh, but across sectors, the dependence on imports. And therefore, what we are looking to do, and this is, I think, a turning point topic, is import substitution has become very serious and critical. The CFO's role is business partnership with fiscal prudence. So this is one area which becomes critical for businesses and therefore critical for CFOs as to how you do import substitution. Now, there are actually companies I know across sectors from pharma to electronics, which had import dependency about 60, 70, 80%, brought it down to 10% in 4 to 5 years, but it needs investment. And those investments are not capital investments, will go through the P&L. So therefore, the CFO to manage all that. So that is one. The second thing is a step change in the efficiency of our enterprises, manufacturing, services, etc. Because we want to be competitive, not only domestically, but we want to expand our international markets. We want to take advantage of all the trade treaties that the country is going into with countries and blocks. So therefore, we have to be competitive, and there is a step change which is required in efficiency. And I think there is a big gap there of efficiency of Indian enterprises in general to where it can go, and we can talk more about that in, when we get to the next part. The third thing I think Arnab covered is regulations. Now, the fact is we still have too much regulations in this country, and it is kind of a thing that you have to deal with. This is something that foreign companies are very skeptical about before they decide to start business in India. But it is also true that this is becoming more prevalent. Now, hopefully, with the kind of tech that Arnab was talking about, it becomes more smooth to deal with because they're all talking to each other. But it's a real area. So,
I mean, I want you to add more, but I will come to it. That is meaningful one. So, Ashutosh ji, to begin with, obviously, I want you to speak about turning point. But since you come from a pharma, I think that is the only sector where Trump is still going slow. What kind of medicine have you guys given him?
No, yeah, so pharma is a defensive sector, so far untouched by the tariffs. But let's see how things shape up looking at the Trump, and very difficult to predict anything. So, yeah, turning point. Since I represent pharma, so I will be talking from the pharma standpoint. So let me break the turning point into three parts. One has been the historical turning point, what's the current state, and what will be the next turning point. Historically, the turning point was the Indian Patent Act 1970. Because of Indian Patent Act, it created a differentiation between the product patent and the process patent, and which helped the pharma industry in terms of scaling up affordable medicines and making it available and accessible to the public at large. Second turning point came during COVID. So three things happened during COVID. One was the domain dominance got changed. That was one. Second was with regard to the change in the business models which took place. And third was the increase in the penetration of insurance. In terms of business model, we have seen the emergence of telemedicine came up, organized retail sector came up, e-commerce, quick commerce, that became a prevalent and growing at a very fast pace. Given that the domain dominance also got changed because the companies, pharma came into prominence, and the companies also went up the value chain from the generic to complex generic to biosimilars and to the biologics. So that was another turning point which took place. The third was insurance, both by the government as well as by the private players. The government came up with Ayushman Bharat, which is covering 90 crore of population, and the private players also scaled up, so they are covering close to 40% of the middle class population in the insurance coverage. The next turning point, what we are seeing is the patent cliff, because drugs worth $125 billion are coming off patent in the next 3 to 4 years. Indian pharma size is close to 30 billion, and if Indian pharma is able to capture even 3 or 4% of this, so which will translate to 5 to 6 billion dollars of revenue. And the Indian pharma is very well poised, looking at the technology upgradation, the AI adoption which has taken place over the last few years, especially after COVID. So this is the one turning point, and as a CFO, we have to be vigilant and we have to see how we can outperform, outsmart, and capture this opportunity. Yeah, thanks.
Yeah, relevant one, in fact, notable points, Ashutosh ji. Whenever I, being a finance journalist, used to meet a lot of financial analysts earlier or the market analysts, they always said one thing: आँख बंद करके फार्मा के स्टॉक खरीद लो. So that's the pharma growth story here. But thanks for those points. Deepak ji, obviously turning point is an important question that I want you to answer. But before that, sir, why the Jaquar products are so expensive?
Actually, it is not so expensive. We need to think about the product quality and the customer service. This is the main philosophy behind the Jaquar Group, basically. Product quality and even the customer service is available for the even till 10 years. 10 years free of cost. So that is the cost. Basically, for that the consumer is paying the prices. I think value for money. Yeah.
Sure. Turning point, sir, please.
Turning point.
Mike,
I think turning point. Although Mr. Sircar has already told, and my friend speakers have already told, in my opinion, the next turning point, because with this geopolitical situations and the trade imbalances, in my opinion, that India has to become a manufacturing hub, basically the make in India, and the import substitute, which is already told. With this import substitute and the manufacturing hub, the cost competitiveness will automatically lead, and once the cost competitiveness will lead, then the trade imbalance problem as well as the tariff issues will be resolved to a certain extent. Like government has recently done some GST things just to boost the consumption, just to support the exports and everything. But in my opinion, that the manufacturing hub, the competitiveness, if India becomes the leader, then definitely all these problems can get resolved.
Okay, sure. I think that is going to be the most integral factor of India Inc. The way we push Make in India going forward, right? I mean, the industry is still looking for more incentives that side to pick up that front. But thanks for adding that. And let me go with some specific questions. Arnab ji, let me start with you again. And thanks for sharing your view and vision about the turning point. But now the specific question I have for Arnab ji is this: from allocating capital to electrification to logistics distribution to hunting talent, many challenges that we see. How do you allocate costs? What kinds of metrics do you follow to manage cost and ROI?
I think, look, the starting point of this is a plan beyond 1 year. Because for us in Maruti Suzuki, and we have already announced it to the market, our next wave of the plan, which we call Maruti 3.0, this is where we see the company in 2031. So that plan is already announced, which is our guiding north. So everything is getting now aligned to that guiding north, which is already there. And the choices are between what is good in the long term, predominantly, and particularly from a CFO's perspective, differentiating between a good investment and a bad investment. See, we need to create capacities for some good investment. For that, with the advent of tech, we need to be a little severe on some of the elements of cost which can be controlled, so that we have some capacity created for some good investment. Now, for example, we talked about sustainability, but if we have to really go toward an accelerated net zero, the path comes with an investment. It will not come without an investment. And one will have to create a capacity within the P&L for that. Now, how do you create the capacity? How do you consciously take it in the quarterly results and build it for future? Is the balancing act the CFO has to do. So I would say this is really important. I think the second thing is, you had an EPM presentation today. You will probably have one more in that day. I think with the advent of the whole tech part of it, the visibility now is at a much more granular level. So take advantage of that. Be very clear on where are you consuming your resources. Have a philosophy of return on capital employed at each granular level. Sugata and I both can share an example. We were in a French company, so very traditionally run. Then suddenly we had a private equity coming in. So what happened in that company is the metrics for every business leader was changed to a return on capital employed. And it has become a case study now in Indian history. The private equity came at a certain level. In 5 years, they exited at 10x. So if you need a valuation like that, the ROC has to be driven at a granular level. And as CFOs, it's our responsibility to ensure that we are focusing on the balance sheet with that much more granularity, like the way we are doing on the P&L. So this is one aspect I would leave it to you, because go granular. If you have to really look at it, balance between the short term and the long term, balance between the good investment and something which is good to have but not must to have, and look at where technology is helping us. See, sales and marketing costs, particularly the marketing cost, is one area which is drastically changing with technology. You don't need the kind of infrastructure we needed earlier. Now with AI, the kind of images you can get, that whole thing is revolutionizing. So challenge each and every area of your P&L and create capacity. It's all about creating capacity and investing for future. I will leave it at that.
Interesting, very interesting, Arnabji. Mr. Sarkar, the question is, I see a strong growth focus from the whole industry on the renewable energy side. The government is also pushing that front. So how is the shift from fossil fuel to renewable in your view? How are you financing it? And is the focus on becoming a green energy company is on the radar? How long will you take? Just add some thoughts on that front.
Yeah, no, so I can talk for the renewable industry, and this company in any case, which I advise now, is fully into renewables. See, in the renewables industry, and I wanted to reflect a little bit on what Arnab was saying, if I may, because that will be connected. So he was talking about how you measure returns, etc. Now, what I've also learned over a period of time is different companies, which means different kinds of ownerships, will measure returns differently. So strategic companies, which are normally the companies that we understand, his current company, the one which we worked for, Schneider, etc. These are strategic companies, so they have a certain outlook. So they will look at return on capital employed, etc., etc. But if it's a fund investor-driven company, I have seen that the measure is slightly different. The focus is entirely on return on equity, and this actually has impact on financial strategy for sure, but sometimes the actual strategy. Now, so having said that, so in the renewables, to maximize your IRRs, there are basically 3 blocks, maybe 4. One is the project cost, second is the tariff, third is the financing, and fourth is the operating performance once you have renewable assets on the ground. So the CFO's role goes beyond financing because it has impact on IRR. So even when you're conceiving a project and the whole project plan, the timing of closing the purchase of critical equipment like modules or wind turbines, how you structure the EPC contracts, and these things are going to have a bearing on the project cost and obviously then on the IRR. The timing for tying up things like land or connectivity, which are small portions of the overall project cost, but are on such a critical path that if you do not take the right decisions at the right time, then it impacts. So these are drivers which are used, and this company also uses that. In terms of financing, while the financing of each project is the traditionally the equity debt combination, so 25 equity, 75 debt, 30 equity, etc. But even within the equity, you need to take a call of how much you want to put in as pure equity and how much you want to put in as quasi, like intercompany loans or convertibles, because then once the project is running, you have a better flexibility of moving the money. and this again impacts the IRR. So these are things which are very important in this industry, and this is how you manage it, because once you sign the PPA, as you mentioned, the PPA, you're tied in, so your pricing is fixed for 25 years. So therefore, how you manage the project, how you manage financing, how you manage operating performance, all will all make a difference. Last point is a lot of tech is coming in for the management of the operating performance. These are huge plants, very large plants, and you need so there's good analytics now available on managing these plants, predictive maintenance, etc. So these are the ways.
Very relevant one, and we need green companies, we need renewable energy, clean tech for sure. Ashutosh ji, let me come to you. I think whenever we speak about manufacturing or India growth story, I think what is one aspect always missing is the R&D part. And in pharma that matters the most, right? So I just want you to add on that as we are at the juncture of new turning point. Uh, the lack of investment for R&D is always a topic of discussion. So how do you handle this and ensure enough budget for R&D, and importantly, also accomplish the metrics of your ROI?
No, absolutely. It's a very, very important question. And if you want to grow exponentially, investment into R&D is of paramount importance. So if we pick up top 10, 15 Indian pharma companies, the average spend on R&D is in the range of 5 to 6% of their revenues. If we compare it to US top 15 companies, their average spend is upward of 20% of their revenue on the R&D. And if we see the value share, the India's share in the US import in the pharma, 6% is the value share and 30% plus is the volume share. So the delta between the value and the volume is more than 5x. So now, historically, there have been certain headwinds for the Indian companies to invest into R&D. One has been the price cap, because there is a limitation on the price increase which can be taken, as well as certain essential list of medicines. There is a price capping on that. So that was a bit of a deterrent for spending into the R&D. So that was one piece. Second piece was lack of rigorous enforcement around the IP infringement. So which forced the companies to spend more on the marketing, brand building, rather than on the R&D front. But post-COVID, there has been a shift in that. The companies are moving up the value chain. As a CFO, two matrices are very important. ROI is fine because there is a lot of factors which goes into that. The probability of success, the time, there are a lot of uncertainty in the R&D spend. But two factors one should always track. One is, what is the portion of revenue is being allocated towards the R&D? As a CFO, in every monthly meetings, everywhere showcase how much money is allocated towards the R&D. What's the R&D spend as a percentage to revenue? That's one parameter. Second is to show what is the contribution of the new product launches in the overall sales of the company. Report, highlight, debate these two things in whatever meetings which are there, because it's very important in order to get integrated into the global supply chain and to move upward. It's very important to increase the R&D spend. So as a CFO, we can report it, we can highlight it, go granular to that level to showcase and build up the R&D budget from the stage gate approach, in the sense that milestone-based R&D, success-based funding can be allocated towards R&D. So these were my 2 cents on that.
No, they were not 2 cents, sir. That's some $1 million thoughts. Very, very meaningful one. I'm going to Deepak ji for a very specific question, but after that I will come to you. Be ready if you have any specific question. The time is limited. Please be ready with the mic as well. So Deepak ji, the question is specifically about the diversification, business and capital allocation. So as a CFO, how do you balance capital allocation between sustaining the core business and fueling the diversification into new product lines, whether domestic or international markets?
Actually, this Jaquar Group is a almost $1 billion company in terms of the turnover for this financial year. But being a closely held company, the promoters believe in the own capital. So basically, this is a debt-free company. Whatever funds, debts we have, this is for the non-fund-based facilities. What we are doing that we are plowing back our internal accruals for the greenfield projects. We have the 8 manufacturing facilities, 2 more manufacturing facilities are coming. And beyond this, capital investments, we have to do investment in the called the experience centers or the orientation centers. Like we all over world, we have around 40 Jaquar world where the customers comes in, steps in, and see our product, and then go for the decisions for purchasing decisions. So that is the important thing for the as far as the investment is concerned. Another important thing as a CFO, which we have to manage, that the working capital for the emerging business or the new verticals. So, working capital is important, the management of working capital, and for our partners also, because we are not using any fund-based facilities for the partners from the dealer side, for the vendor side. We have the financing product that to support them. So that thing we already have. So this is how we are managing. Basically, the important thing is the capex and the working capital. These are the two things which we have to take care as a CFO.
Oh, sure. Noted your points. Deepak ji, anybody has any specific question? Can we have mic there?
Hi, question is to Mr. Arnab. You mentioned about custom talking to income tax. So can you please elaborate a bit on that? I mean, what do we expect from there?
Yeah, I'll probably see what is going to happen with that is now the availability of data at the public domain with the regulators is going to be much higher. So historically, if you see, way any intercompany transactions used to get justified from a transfer pricing perspective was the transactional net margin method. So if you follow the OECD guideline, it is the fifth method or the residual method. Now think of it, rewind a little bit. If you are going to have more direct data, what is the best method? Best method is the cup. And if the journey goes from the TNMM to cup, the kind of questions which will come is going to be that much more magnified. So that's the direction. I may be wrong, but that's the direction it can go. So that was the point. Be prepared for it.
Sure. Any other question? Yeah. Yes. Any other question? Anybody has? Yes. Can we have a mic here on the first table?
Hello, sir. My question is to Mr. Dhawan, and thank you very much for the great insights. You mentioned about the 5 to 6% on the R&D spend. How do you see that from industry perspective? Is it impacting your competitive advantage when you compare that to the industry, or is it okay or in line with the wider pharmaceutical industries?
So every company, they have their own philosophy that where you want to play. So if you just look at the simple branded generic company, there the R&D spend is not high, because there it's more around the process R&D where you can achieve efficiencies and all. Some of the range of R&D spend is varying from 2% to 12% within the Indian pharma companies. That I spoke about the average, but as you have to grow, you have to increase the R&D spending, because innovation is something that can give you the delta or the alpha in the growth. With the existing products, existing portfolio, you can take it to a certain level through marketing spend and all. But if you have to leap forward, then you have to increase the R&D spending.
Thank you, sir. Thank you.
Sure. Any last question anybody has? Okay, no worries. The time is limited, so I will take one quick question to all of you. Like we spoke about turning point. The theme of this event is, the new age CFO or the modern CFO. As we have seen, this role is transforming. The world is transforming and things are changing so rapidly. So the question is, in your view, what is a digital CFO? How does digital CFO look like? Starting with you.
I think fundamentally for a digital CFO, he has to be a process expert, because at the end of the day, digitization is all about your process knowledge. I'll put two simple examples. See, AI is going to change all our lives, but there are two aspects of AI. When you are querying inside the company, when you are querying in the public domain. When you are querying in the public domain, you have a lot of partners who will help you, a lot of data. When you are querying inside the company, what you need is strong, robust processes. What you need is your system of record has to be stronger. The data lake or the data house, that's a new word. The whole structure has to be robust. Then only you can have meaningful query inside your database. Most of your business decisions will be querying in rather than querying out. Querying out you will do for customer benchmarks. So keep this dimension in mind and prepare on the back end invest on your talent so that they are real process guys. They can take a step, go back from a distance and see. This is going to be the big turning point in my view.
If I may, the digital part is an enabler. So Amol, if I may, I'll just say that I think since the topic is new age CFO, the thinking differently has to come from the fact that you have to be even more aware today about the geopolitical or the economic environment and understand what is the best thing for the business. We talked about a few things like import substitution or efficiency improvement. There could be other things, but the CFO today has to be, I think, much more aware of what is required for the business and see how to partner it. Is what I think. And in efficiency especially, I think the CFO can spearhead a culture where you are continuously looking for efficiency improvement. So there are some great companies globally who have done it well and continue to do it well to learn from, but the CFO is the best place, is in the best place to spearhead that, I think.
Yeah. So I think the how to extract the value out of technology is very important. A CFO should know how to extract value from technology without getting into the technology trap. Because what happens is that in one or two function, we do optimization, reduce the headcount, but you end up adding up more on the other side. So CFO has to be very, very careful as a technology advisor as to a resource allocation, capital allocation, how much is getting invested into technology, how the overall technology is fitting into the overall company strategy. That's very important. Keep all the risks in mind in terms of IP protection, data privacy, all those things. So these are some of the things I think as a digital CFO one has to be mindful of.
Yeah, in my opinion, that since the CFO role is changing, that although the accounting, compliance, control, and audit are the part and parcel of this finance function that was there, and this will be there also. But in my opinion, all these things, the transaction processing, the compliance and control, all can be digitized, and in the coming future, all it will be controlled either via this shared service centers or the digital thing, and only the exceptional reporting to the CFO will be there, so that he can invest the time instead of these transactional processing, or he can become really give a contribution to the business as a chief business officer. Basically, he is only the person. He is because all the information, whatever, if there is a financial implication, everything is being accumulated in the finance. So he is only the person who can be next to the CEO, or who can become the future CEO as compared to his peers. Because everything, whatever is happening in the business, almost everything is coming in the finance. So in my opinion, he can think about as a chief business officer next to CEO, the partnership in the business and the solution area.
Sure, those were remarkable points. I must say that there is a synonym to CFO now. There are so many words coming. It's a co-pilot. Somebody said chief business officer. Somebody also said chief value officer. So new hats, and CEO is an obvious transition if there is any scope in the company or any time if there is any change in the company management. Thank you so much for sharing those meaningful thoughts here. Not only about the turning point and specifically about the digital CFO, but about your particular sector as well. And thank you so much for listening to us very, very patiently. Thank you.